Welcome to Candlelight, where price is a mechanical function. I'm Montana. If you're watching this video, chances are you've dabbled a bit in trying to buy or sell stocks, options, currencies, doesn't matter, futures, or you're a passive investor just trying to get a bit more information. It really doesn't matter. But if you've ever looked at a chart, either a stock or an asset that you're looking to or are interested in, and it felt a little bit like this,
I don't need sleep. I need answers. I need to determine where in this swamp of unbalanced formulas squatteth the toad of truth.
we all have, and it's a dark, dark place, but it happens to everyone. What makes buying and selling so difficult is obviously knowing what areas to do it in. And if you've investigated a little bit or learned or trying to learn a bit more or get a bit more information on what technical analysis is, or just understanding how to read price and knowing how to knowing what price action is all about, chances are you've heard the term support and resistance. What is support and resistance? An area of support is just where price is bouncing up and down from. Is that a place where, or is that a place on a chart or in price where your grandmother just happens to give you milk and cookies when you stop by? Or is the area of resistance where price can't break above your not so friendly mother-in-law that doesn't want you around? That word, or those two terms, support and resistance, really doesn't help you understand what's going on. I'm old school. I love asking the common sense question, or the common sense test, which is always a very simple understanding of what, or a very simple question of what something or how something works. Simple question should yield you a simple answer. What is support and resistance? When it comes to price action and looking at a chart, there's no simple answer. Why is price being supported at that area? Who knows? Using that term, it can't be answered. With supply and demand, that's time tested. Economics 101. More demand than supply, price goes up. More supply than demand, price goes down. An area of demand is just an area where people are putting a whole bunch of buy orders into the market, hence making price go up. And in an area of supply is where people put a whole bunch of sell orders into the market, making price go down. Plain and simple. Awesome, Montana. Well, yeah, everyone knows Economics 101, supply and demand, price moves. What does this have to do, or how does this help me with trading or looking at a chart? Because it all ties into speed of price. Speed of price is represented by candles. A candle is made up of two pieces of information: distance and time. Price travels in money a certain distance in a 60-minute period if you're looking at a 60-minute chart, or a 5-minute period if you're looking at a 5-minute chart. Well, what's distance divided by time? Velocity. So if you have an area where price leaves ballistically from, you get good 90-degree angles, 90-degree movement, strong movement out. The only thing that can do that is an overwhelming amount of demand or an overwhelming amount of supply. And those orders still exist in the market after price moves away from those areas. Well, what does that look like on a chart? Well, let me tell you, it's actually pretty simple. A good zone, both to the upside and to the downside, has several characteristics. Not all of them, but a good zone should have most. A good demand zone, a good supply zone should be the origin of either a strong ballistic move or should be the origin of a relatively long-term trend in whatever time frame you're looking at. The origin of a year-long trend, it's a pretty powerful demand zone if it's to the upside, or a supply zone if it's to the downside. If you were to look at a spaceship, where does or when does the rocket have the most amount of fuel? At the beginning of its trajectory. A cannonball, where is most amount of, or when does a cannonball or a cannon have the most amount of gunpowder? At the beginning of the beginning of the cannonball's trajectory. Price action is no different. The fuel that drives price or that moves price are buy orders and sell orders, demand and supply. Another thing, or another fantastic characteristic of a good zone, is that it breaks opposing trends. Let's just say that price is going up. You should go long in an uptrend. But you also don't want to buy high, you want to buy low. Well, Montana, if price is in an uptrend and it's coming down, doesn't that mean it's actually in a downtrend, or at least midterm or short-term downtrend? Yes. Well, then doesn't that mean that you shouldn't be buying? Well, yeah, kind of, sort of. I know it sounds confusing, but all you need to know is that a good zone will not only be the origin of a large move, but it also should break opposing trend lines. If you're in an uptrend and prices coming down, which is what you want to be seeing to begin with, and it's coming down in the short term, and price breaks above a trend line, then that origin of that move is a demand zone that broke above trend lines, which is what you want to be seeing in an uptrend, is price breaking short to medium term downtrends. And when and if price enters that area, you go long. Those are good zones. Another common characteristic is that they break, both supply and demand zones break opposing zones. Let's just say that you have a strong demand zone, either the origin of a long-term trend or an origin of ballistic movement out to the upside. Let's consider those zones to be the Hulk. They're really strong. Hulk's a pretty bad dude. If you beat the Hulk, then by definition, the only thing that could have beaten the Hulk is something that is stronger, better, faster than the Hulk. And if you have a supply zone that beats the Hulk, then you really want to be moving with supply instead of going against it. You want to short that supply zone that kicked Hulk's butt, instead of, well, going long against that. You're going to lose. So good zones break opposing zones. Another common characteristic is that they give you a good or large price curve. If you want to know what that technical term is, then leave a quick comment in the comment section. I can talk today, and let me know if you want me to do a segment on what a price curve is. But if price gives you a good, or if a supply or demand zone gives you a good price curve, then by definition, price had to have moved a decent area away from the origin of that move. If and when price comes back down to that area and that price curve is large, then that price curve, because price is a not only mechanical function, but is kind of think of it as a living organism, it's going to be exhausted by the time it gets there. It's going to be one of those runners at the end of 40 something miles or however long those a marathon goes for, that is just barely making it. Which ties into what we were saying about leftover orders. This is where the beauty of all these odds enhancers and picking the best zones that have all these qualities is when price is entering an opposing zone and is exhausted. It has broken that zone has broken a trend line or broken opposing zones and is the origin of a large move. By definition, all of those characteristics is that origin of a large move has unfulfilled orders. The reason price moves ballistically away from that is ballistically away from a zone, both to the upside downside, is because there's a huge imbalance. Well, if price moves away from that zone, then the leftover orders that are there obviously were not able to be fulfilled, but that does not mean that they're gone. They're still there. So when price is tired, already not having a lot of momentum and just orders behind it, at its weakest point, it is now going to enter a very strong area. And on top of that, you have the self-fulfilling prophecy that Wall Street, the guys with big money, the institutions, swinging hundreds of millions of dollars a day, swinging large bats, know that you buy in areas of demand and you sell in areas of supply. So then the big guys just pack on more of the orders that you should be executing yourself. In a demand zone, they pack on buy orders, and in a supply zone, they pack on sell orders.
Get back in there at once and sell!
It's simple math coupled with a self-fulfilling prophecy that everyone knows. And can you just imagine if more people knew about technical analysis and how to read price and what is actually going on behind the candlesticks, because you now know that it's supply and demand, not support and resistance, then everyone would buy in demand zones and everyone would sell in supply zones. Well, not everyone, but most of the people. And then wouldn't the market just work that much more smoothly? because everyone's selling, or there's even a larger amount of sell orders going in the supply zone, that supply zone will inherently work better. And the same is true for a demand zone. So that's the beauty of technical analysis and learning how to read price. It's not complicated, it's not math, it's just good common sense. So stick with the common sense test. If something is going on in the market that is not simply explained and simply conceptualized, chances are it's not the thing that you should be focusing on. Supply and demand is what moves markets. It's the hemoglobin of all price action. Price movement can only be moved by a buy order or a sell order. So if you're going long, look for demand zones, look for an uptrend and wait for price to come back down, and then wait for a good zone that has at least a few of those characteristics that we just went over to present itself. And then wait for price to get tired into that zone and then go long. And the same thing with going short. Look for a downtrend, short supply zones. Just look for good quality zones that are powerful enough to do, breaking trend lines, breaking opposing zones, create long-term trends, and go short those origins. All right, guys. See y'all on the next one. Trade safely.